This video will show what the widely used PE ratio doesn't tell you. So we're going to cover a few basics of what the PE is. We will then show why the PE ratio is just a shorthand version of a proper discounted cash flow analysis. And we'll then show why growth and risk assumptions which are embedded in the PE ratio are not visible. And lastly, we will show why PE by itself does not tell you if stocks are either cheap or expensive. So just some basic definitions. PE ratio is simply the price of the stock divided by its earnings. Sometimes it's referred to by the earnings yield, which is its inverse. The earnings might be shown as either trailing 12-month earnings, normally abbreviated as TTM, or it could be forward operating earnings. The TTM represents the actual earnings, but it doesn't matter which one you use as long as you are consistent in your methodology. In simplistic terms, you can think of the PE ratio as the number of years it takes to get your investment back. So if you bought a small business which was making $100,000 per year and paid $300,000 for it, you would be paying a PE multiple of 3, and in simple terms, you would recoup your initial investment in 3 years. So that's just a very simplistic way to think about it. A common misconception with PE is people often say company X or the market is cheap because it's selling at a PE of 15. Now what they normally mean is that it's cheap relative to where it once traded previously, not cheap based on any analysis of the factors affecting its present value. And we will explain why using historical average PE for determining relative value is meaningless. So what is an appropriate PE? To answer this question, we need to understand where PE actually comes from. So let's just first show a standard discounted cash flow mechanism here. And we have the following scenario where earnings are $100 assumed to grow at 3% per year, and we will sell the investment at the end of year 10 at a PE multiple of 10, which would result in the following stream of cash flows circled in red. Now, if you discount that back to the present value at 10%, your price will be $11.91 and 42 cents. 10% is the discount rate, but you can look at it the other way. If you paid $11.92 for that stream of cash flows, it would equate to a compound annual return of 10%. So that's the basic concept of understanding the discounting mechanism. Where does PE come from? Again, taking our stream of cash flows, growing at 3% a year for the next 10 years, and then discounting it back at 10% gives us a present value of $11.91. If we take the present value of $11.91 and divide it by the earnings of $100, that results in a PE of 11.91. So that's where PE ratio comes from. It's just a short form of this long form, technically correct valuation method that requires assumptions about the growth rate and the discount rate. When you see a PE ratio, all you're seeing is the PE ratio, but you're not seeing what assumptions were made with respect to the growth or discount rate. And depending on the values that you choose for those two variables, will have a significant impact on the present value. Furthermore, there are actually multiple factors affecting each of the growth and discount rates, so it actually gets more complex. Earnings growth is a function of real growth, inflation, and change in profit margins, and the discount rate is a function of the risk-free rate plus the equity risk premium. The equity risk premium essentially reflects the certainty of those growth projections. So the more certain the growth projections are, the lower the equity risk premium or discount rate is, and the higher the value would be. So you can see there is a lot that goes into coming up with a proper discounted cash flow calculation, which ends up being condensed into a PE ratio. And so finally, coming back to what is an appropriate PE, you probably already know the answer. It depends on the growth and risk outlook. Technically, the fair value or an appropriate PE is where the risk premium accurately prices the growth projections. It gets determined by market forces because people have different opinions on the risk premium and also on the growth projections, so it ends up being an aggregate of market participants' opinion on those two items, growth and discount rates. Now, because the growth and risk are not constant over time, historical averages are generally meaningless for comparison purposes because we are not comparing apples to apples. So to say a PE of 15 is cheap relative to history may be true, but historical growth expectations and discount rates are not likely the same as today. So it is not a meaningful comparison. So in conclusion, PE ratio is just a shortcut valuation method. Without knowing the growth and discount rate components embedded in PE, there is no way to know if PE is priced right, is cheap, or expensive. And given that growth and risk are not constant over time, historical PE ratios are not relevant in making investment decisions.